Chapter 18, Public Choice, Taxes, and Distribution of Income. So in this chapter, we're going to cover public choice, the tax system, the tax incident revisited, and income distribution and poverty. So what is the role that government should play? This is a big question, and this is a big question that comes up frequently in the political candidates and all kinds of decisions in the government. So far, we have seen relatively limited evidence for government intervention in markets. Governments have been able to reduce dead weight loss, which is to improve economic efficiency by ensuring public goods are provided, regulating markets with few firms, and altering the quantity traded in the presence of externalities. But how can we tell what the government should do? For example, when choosing between competing public projects, should we spend money on cancer research? Should the government be spending money on transportation issues? Should the government be spending money on higher education? And then when deciding whom we should tax, so how are we going to pay for this and how should we tax them? We will study these types of questions in the next chapter. So, public choice. An important insight of the recent research on governmental activities is that government policymakers are people too, rationally interested in themselves, just like consumers and firm managers. Remember the three economic ideas that people respond to incentives, right? So government workers are exactly the same. They are people that respond to incentives, and that they seek to make themselves as well off as possible, which often involves increasing their re-election chances. This is always one of those reasons that I argue for term limits on this scenario, because it's a human nature to act within our own best interest. The public choice model is a model that applies economic analysis to government decision making and can provide insight into the decisions that governments make. So, an example. So this is the voting paradox. Suppose that Congress must spend $1 billion on only one of the three alternatives. Now, this is to give an example how the voter majority doesn't actually always mean that you're going to select what the voters majority would want. So, you only have 3 voters and 3 choices, and you must spend all of it on one thing. The policy is cancer research. The 3 voters are Lena, David, and Kathleen. Lena wants, in her ranking, cancer research to be first, mass transit to be second, and border security to be third. David wants cancer research to be second, mass transit to be third, and border security first. And Kathleen wants cancer research last, mass transit first, and border security second. So the votes. If cancer research was versus mass transit, cancer research wins. If mass transit versus border security, then mass transit wins. And border security versus cancer research, border security wins. For simplicity, there are only 3 voters with preferences in the given table. Now, the voter paradox says the failure of the majority voting to always result in consistent choices. If these policies came up for pairwise vote and the voters voted according to their preference, the outcomes would be in the second table. So there appears to be no way with majority voting to aggregate preferences into a sensible preference ordering for society. This is known as the voting paradox, which is the failure of majority voting to always result in consistent choices. But it turns out that not only can majority voting fail, so can other types of voting systems. So the arrow impossibility theorem is a mathematical theorem that holds that no system of voting can be devised that will consistently represent the underlying preferences of the voters. Then there is the medium voter theorem. Since majority rule is so prevalent, it is important to understand the consequences. One consequence, known as the medium voter theorem, is the proposition that the outcome of the majority vote is likely to represent the preferences of voters who are in what we would call the political middle. The figure shows this ideal, shows the ideal policies for 5 voters. There is a $2 billion preference policy of the median voter would beat any option in a pairwise. So let's assume we go back to the spending. So there's $6 billion to spend, and on cancer, potentially up to $6 billion to be spent on cancer research. Kathleen votes to spend none of it on cancer research. Jerome votes to spend $1 million. David votes to spend 2. Steve and Lena, Steve says 4 and Lena says all 6. Well, based on the median voter theorem, the 2 billion would win. So, but that's not actually what the majority would want, or an averaging of this, or however you want to get to that idea. So we've seen that previously that markets might fail to achieve the maximum possible surplus for society, but governments might fail in that respect too. We will consider 3 ways in which the government can fail: the idea of rent seeking, log rolling and rational ignorance, and regulatory capture. Rent seeking refers to the attempts by individuals and firms to use government action to make themselves better off at the expense of others. This happens in lots of different industries. Sometimes when you read reports on how something was approved and you start to question yourself, like, who does that benefit? Does that benefit all of society, the majority of society, or specific people in society? So rent seeking, there's an example of the U.S. sugar firms have successfully lobbied the government for a quota on sugar imports. So this basically limits the number of sugar, the amount of sugar that can be imported, which keeps the price of the product high. Think about this. If I am a sugar manufacturer and I could, other people could import it from other countries, but I'm a U.S. sugar manufacturer, and I could keep my price high by lobbying the government, firms may offer campaign contributions to policymakers and in exchange for what we call special interest legislation. So although the number of sugar firms and in the U.S. and the number of workers working for these firms is small in comparison to the overall U.S., they have successfully lobbied for sugar import quotas. That's rent seeking. 2, log rolling and rational ignorance. Politicians gain support for their proposals by offering to support those of their colleagues. This is known as log rolling. And this could be a reason why sugar quotas continue to exist, even when they benefit relatively few people. If you think about it, the people who are in the areas where sugar farms are, then they would want to convince people in other areas to vote for them. In exchange, what they'll do is vote for something potentially in Texas that they want, and this is called log rolling. And this is how we have all these special interest groups and all these things where you find out later that the government spent millions upon millions of dollars on these projects or things that benefited very few in society. So, but why wouldn't voters vote out of office people who support in such inefficiencies in policies? Well, this is called rational ignorance in economics terms. So, oops, sorry, touch my my mouse here too quickly. So rational ignorance. Rational ignorance is the idea that although you might think that people would vote out people who had inefficient policies, the time needed to research this and the economic effect on individuals. So in the sugar example, although there's these quotas that have driven up the price of sugar, which have hurt the candy operations and all the people that work for candy and all the other people that use sugar and bakery goods and things like that, they have an effect on all those employees because that price of sugar has been maintained artificially high, if you will, by putting on an existing quota. Why won't voters vote people out? Because the loss of surplus per person on the sugar quota is only about $10, and many voters remain what we call rationally ignorant of such ideas. Basically, it takes too much time and effort to research and understand the idea of the sugar quota And because it only hurts you by $10, you people who are voting just choose to be uninformed about this because it's not worth their effort. This happens in class when people decide it's not worth their effort to do something. I mean, this all goes back to the whole idea of rational ignorance, right? Now, when we're talking about regulatory capture, in this principle, regulatory agents like the Food and Drug Administration exist in order to safeguard consumers. But firms that are significantly affected by regulatory agencies have an incentive to make sure that the agencies are on their side. Think about this. If you think about the financial crisis and the rating agencies that were supposed to rank the bonds and the AAA bonds, but they were actually being paid off by the companies. And then this goes back to economic incentives. So you're supposed to regulate, but who's paying you? This goes back to Sarbanes-Oxley, and the audit firms are collecting money from the people that they were supposed to be auditing. Again, go back to the idea of where is the incentive, right? We always have to ask ourselves this: where is the incentive? So an agency which is acting more in the interest of the firm it is supposed to regulate has been subject to what we call regulatory capture. Some might say the SEC was participating in some of this scenario where they kind of had information. They had information on the Bernie Madoff. They had information on this. People brought forth the idea of these housing bubbles. But one example is the defunct Interstate Commerce Commission. It was set up to regulate railroads and trucking firms, but it ended up instead preventing competition in the industry and making a significant gain for few at the deficit for many, right? So is government regulation even necessary? The preceding slides paint a grim view of government regulation, perhaps enough to make us wonder if government regulation doesn't make us worse off. Recent estimates suggest that the cost of federal regulation may be several thousands of dollars per taxpayer. However, many agencies do important work by protecting consumers and safeguarding the environment. Many people will say if we had no regulations, people would run amok and greed would take over, or greed has already taken over. So again, we go back to what's the incentive and where does the incentive lie and how is someone going to react to that incentive? It's usually bad when we assume that someone's going to do something against human nature in order to make this situation happen, right? Economists can help to identify the costs and benefits of regulation in order to help policymakers make good choices. Now we move on to the next topic in this, which is the tax system. We're going to explain the tax system in the United States, including principles that govern the use to create tax policy. Government spending must be financed somehow. Most revenue relies on taxation, which includes individual income tax, social insurance, which is Medicare and Social Security tax, corporate income tax, sales tax, which is property tax, and excise tax. So the next slides will show how common each of these are in the United States. So, federal, state, and local sources of revenue. Social Security and Medicare taxes and individual income consist of the majority of the federal government's tax revenue. So this is a graph from 2014. 41.6% came from individual income taxes and 34.8% came from social insurance, which is Medicare and Social Security. So the amount per household is $11,160 in individual and $9,333 in social insurance. Corporate income taxes are relatively less important, as are excise taxes, which are taxes on specific goods like gasoline and cigarettes and other things. So corporate income taxes represent 15.1%. But I know people usually go crazy like, oh, the corporations aren't paying enough, blah, blah, blah. But you have to remember, everybody that works at the corporation or owns part of the corporation or anything, they're filing individual income taxes. And many businesses are what we call pass-through entities, which pass the money earned in a business into the individual income tax bracket ratios. So they're really being taxed on business income through individual taxes instead of what we would call corporate taxes. So the sources of revenue for state and local governments are more varied. Grants from the federal government pay for federally mandated programs and are such a significant source of revenue for the states. So grants from the federal government represent 28.4% for these are for state taxes, because again, the federal government collects federal income taxes, but then they go ahead and they pass on grants to have Medicare programs, to have federal education, to have school education, all kinds of different things. 20% is property tax, so this is the property tax that you pay on the value of the property you own. Sales tax is in a state that has sales tax. Not every state has all of these things, but this is a generic overview of how states collect taxes. Individual income tax, in Massachusetts, we have individual income tax, we have sales tax, we have property tax, they do get grants, and then other and corporate tax. So corporate tax represents an even smaller part of the state budget and revenue. And other things can be other taxes on cigarettes or gambling or the lottery, if you have the lottery, any of these things. So let's talk about social insurance programs. An important role of the government is to assure minimum levels of income to needy groups. Social Security provides cash payments to elderly retired workers, the disabled, and widowers with children. Medicare is a form of medical insurance for the elderly. Medicaid provides health care for poor people. Temporary assistance for needy families, or TANF, provides various forms of financial assistance for a limited time to poor families. The first two are administered by the federal government, which is Social Security and Medicare. The latter two are administered by states, but federally mandated and funded through state grants. Remember, we saw that flow through of state grants to the state, federal grants to the state level. That covers Medicaid and temporary assistance, which is also known as SNAP or food stamps or something in that realm. Medicaid is the health insurance in Massachusetts, talked about as Mass Health. So what types of taxes are there? A tax that is said to be regressive if people with lower incomes pay a higher percentage of their income in tax than other people with higher incomes. Social Security tax, your tax on the first 118,000, I'm roughing that because it's always adjusted for inflation, of your earnings, and then nothing after that on the Social Security tax. So that's what is considered a regressive tax. A tax is said to be a progressive tax if people with lower incomes pay a lower percentage of their income in tax than people with higher. So currently, the individual income tax brackets are set up in a progressive tax way. The tax that constitutes the same percentage of income for lower income people as higher income is called a proportional tax. An example of a proportional tax is a state sales tax. So the sales tax is the same as you just paid on whatever you buy. So, federal income tax brackets and rates for single taxpayers in 2015. So, if your income, taxable income, right, is less than 0 to 9,225 is 10%. And then you go up from there, from 9,000. And again, if you make 189,000, it's not all taxed at this. The first 9,225 is taxed at 10%. Then the difference is taxed at 15, and then the difference in this bracket is taxed at 25, and then so on, and 28. So not all of it, you don't get a straight across the board 28% because you hit this bracket. And taxes are paid on what we could call in our tax system in the U.S. adjusted gross income. It is calculated by subtracting exemptions and deductions from your actual income in order to get what we call taxable income. An example of taxable income, assume Matt earns $100,000 in adjusted gross income, or AGI. Matt will pay 10% of tax on the first $8,925 and 28% on the last $9,249 of his AGI. So Matt, here's the calculations. On the first, Matt pays this. So Matt's total tax is $21,071.25 on $100,000, which is not actually his marginal tax rate, which is 28%. It's actually an average tax rate of 21%. The marginal rate is the fraction of each additional dollar of income that must be paid in taxes. So if I'm in a 28% tax bracket, my marginal is 28. So if I earn another dollar, 28 cents goes to federal taxes. The average rate is calculated by taking your total tax divided by your total income. In the prior situation, Matt paid $21,071.25 on $100,000 in income, so his average tax rate was 21%, but his marginal tax rate rate was 28%. Economists tend to concentrate on marginal taxes since they are most relevant for labor supply decisions. They apply to any additional income that people earn. So which groups pay the most in federal taxes? So are federal income tax rules truly progressive? The deductions available could conceivably make them not so. This is sometimes an argument that is covered. So this table above shows the share. So you have the income category, the lowest 20%, the second 20%, the third, all the way to the highest 20% and to the highest 1%. And so the share of total income earned and then the total share of federal taxes paid. And if you look at the bracket, it does say, based on those table calculations, that federal taxes are progressive. Whether the federal tax system should be made more or less progressive remains to be a source of political debate. Now let's talk about corporate income tax and the idea of double taxation. The federal government taxes corporations on their earnings via corporate income tax. These are also progressive, with tax rates from 15 to 35%, but it is unlike individuals. Most corporations' earnings are taxed at the 35% level. Some economists argue that taxes ought to be assessed only at the individual level rather than corporate level to avoid double taxation. For example, people that own corporations are actually people, right? So somebody owns shares, whether they're wealthy or however we define them. So they get the company is taxed, and then when they distribute the money, the earnings to the owners, it's taxed again. Another alternative is to tax at the corporate level, leaving income obtained via investment or capital gains untaxed. That's another idea. So corporate income taxes rates around the world. So one of the big debates is we hear a lot of things about what is called inversion and people leaving the United States due to tax rates and all kinds of things. So many countries have been reducing their tax rates recently in efforts to attract companies. It's so global now, there's a large opportunity to potentially leave in order to make the most money for your shareholders or in order to, have more income. For example, Ireland has been able to attract some foreign companies like Microsoft, IBM, and Dell to relocate their facilities there. Because of locating overseas and for other reasons, many U.S. firms pay marginal tax rates much lower than 40%. So let's talk about it. In 2000, France had a tax rate of 37%. We're going to compare this to 2014. France has dropped the rate from 37 to 33. Germany, 52 to 30. Ireland went from 24 to 13. Italy, 41 to 31. Japan, 42 to 36. Spain, 35 to 30. Sweden, 28 to 22. UK, 30 to 21. Every single one of them has dropped their rate except for the United States. And we do, as you can see, have the highest corporate tax rate in developed countries. So in selecting which taxes to use, the governments take into account the following goals and principles. 1, the goal of economic efficiency. 2, the ability to pay principle. 3, the horizontal equity principle. 4, the benefits received principle. And 5, the goals of attaining social objectives. Each of these suggests different combinations and levels of taxes. The efficiency loss from sales tax. In the tax literature, deadweight loss resulting from a tax is known as excess burden. Excess burden is a measure of efficiency lost to the economy that results from a tax having reduced the quantity of a good produced, also known as deadweight loss. Low excess burden is a desirable feature of a tax system. So, if you look in here, so this is a supply curve, and this is a supply 1 and supply 2. And this is the demand curve, right? So a sales tax on a good will shift the supply curve up. So from quantity 1 to quantity 2. So if this was the original, supply and demand intersect, right? And then there's a sales tax on the good, it's going to move in here. This is tax revenue created, right? Tax revenue goes up, but this in the yellow is dead weight loss or excess burden due to the tax. So we're not being as economically efficient as we could without the tax. Excess burden will be relatively large to the tax revenue if the quantity changes a lot in response to taxes. This relates to the elasticity of supply and demand. High elasticities lead to high excess burden. Economists are particularly concerned about whether high tax rates on income lead to people working less. So the question becomes, if I know that there's a high tax rate and I'm going to lose all of this money, am I even going to bother to work for that additional money or for that specific amount of money if I feel that working isn't worth it anymore? So the ability to pay principle holds that revenue from taxes ought to be mostly paid by the rich, that is, those who have higher ability to pay. In practice, this means that people with higher incomes end up paying more taxes, a concept known as vertical equity. Income and wealth do correlate, but not perfectly. Income taxes are progressive, reflecting the ability to pay principle. Our current federal income tax is progressive, but some would argue that with deductions and ability for higher income earners to move money and get them in a different way, then they technically aren't progressive. However, sales taxes are regressive since consumption constitutes a larger portion of income for the poor than the rich. So these go against the ability to pay principle. Then there's the idea of horizontal equity. Horizontal equity states that people in the same economic situation ought to pay similar amounts in taxes. This is not an easy to apply in practice. If two people earn $50,000, horizontal equity seems to suggest taxing them the same amount. What if one receives income by working 2 40-hour-a-week jobs, while the other receives income from a lottery annuity? These two people do not seem to be in the same economic situation. Do you think that they should pay the same amount of tax? It's a question for you. Then there's the idea of the benefits received principle. So the benefits received principle holds that governments ought to charge more in taxes to people receiving more benefits from taxes. Funding locally operated services like snow plowing and road maintenance at the local town or city level follows the benefits received practice. However, some government services are designated to help poor people. Taxing those people to pay for those services is probably counterproductive. Similarly, it is often difficult to identify exactly which groups are helped by particular government activities. Example, how will we divide the benefits from the national defense? And then there's the idea, the goal of obtaining social objectives. Taxes are sometimes used to obtain social objectives. For example, alcohol and cigarettes are often seen as undesirable for people to consume, so the governments tend to tax these goods relatively highly in order to discourage their consumption. This is known as what we call sin tax. Is this fair? Is this how we should tax? Okay, I'm going to stop here and then I'll have a secondary set of slides that cover more parts of this chapter.